Good morning. Welcome to this special macro webcast here. I'm with our CEO, Keith McCullough. This is a Stagflation to Goldilocks webcast, and Keith is going to start by giving a brief overview of our macro process. We're going to get into the 7 ETFs to take advantage of this current setup, and then we're going to jump into some questions. So I will turn it right over to Keith.
Thank you, Pickles. Pickles is her nickname, by the way. Emma Vlasic, former Yale hockey captain. She's awesome. And I hope you're having an awesome day. This is big for us in terms of getting a broader audience. We like to do things for free so that we can give other people some exposure and an opportunity to learn about what we're doing over here. It's entirely different. I'll get into that first, then as Emma said, I'll talk about the process, explain it briefly, and then get into some of the current positions, which everyone wants. But first, when you think about why do we have the performance, in particular at this stage of Hedgeye's growth that we have this year, there are really two big differentiating things. Okay, we start every day with preserving and protecting the pile. In other words, we start with what Wall Street doesn't, risk management, okay? We'll get into that. And then secondly, we can go anywhere. Okay, big difference. That's not a 60-40 portfolio that can go in a couple places. That's not just US stocks. That's not just whatever, crypto. We can do anything, anytime, long or short. But again, in the retirement account, the account that I publish every single day, it's called Portfolio Solutions, which you can get through Macro Pro, or even an ETF Pro, which is a much cheaper version of that, but you still get the same positions. Again, you can create a long-only account that goes anywhere. That's called diversification. So again, don't lose money, rule number one, and diversify. Those are not unique concepts in terms of anyone who's studied how to do the job, right? Whether it be in business school or the real school, which is in the market with live ammo and real skin in the game. But these are like just recast in a more modern way using the modern machine as our backstop. Again, we're using market structure as it is today. We're not whining and complaining about it. We're capitalizing on it. So again, we've partnered with a company called Tier 1 Alpha, where we can look at the flow, or the structure of the flow, if you will, the market structure of options and how that drives the U.S. stock market, or we can look at anything that we want to look at of the modern era. What I find fascinating and not entirely surprising is that our competition hasn't evolved quite at all. Right? They're introducing ETFs and all this bullshit that you might want to chase for certain periods of time or gamble on. But what we're trying to do is make sure that your hard-earned capital, the big stuff, is in the right spot and doesn't draw down or crash. So let's just look at that. I mean, the team put this together. It doesn't surprise me on the market crash calls. I know a lot of people have been trying to call a crash this year. There was one, and we called it again. Right? It was between February and April. You can go back, you can rewind the tapes. But 2025, 2022, going all the way back to when I launched the firm in 2008, we have not missed making a stock market crash call. So I do find it amusing, to see all these people trying to become famous calling their first crash or maybe their second one. We've called all of them. Okay? And that's the most important thing to me, is that we have not had drawdowns and crashes of our hard-earned capital. If you want to see when this market's about to go down and go down a lot, I would suggest you use the one insurance firm if you want to consider Hedgeye some very unique insurance that Wall Street pays for. Don't forget, we advise over trillions in assets under management. You should probably ask the firm that's called all of them. So we got that done. If you think about calling the rally this year, again, we don't just go perma-bear once we call one of these things. Yes, in 2023, I overstayed my welcome after making the 22 crash call. That's on me, not on my teammates. We, again, evolved the process, learned from our mistakes. But again, once you get into, this year, we've been bullish on U.S. equities, buying every damn dip since May, okay? And buying the real stuff, right? We'll get into it. We've been long everything from UFO to quantum to triple Qs, and not being concerned about the pending private credit crisis or whatever crisis people, some people started calling for a recession precisely when we went bullish after calling the crash that ended in April. We went bullish in May. And of course, we said there's no recession coming. We'd know. We're the ones with the models, okay? We do a lot of nowcasting on what the economy is actually doing. We'll get into that as well. And then if you just look at the results one more time, on winning. I mean, actually, I didn't even know this number. They're like, Keith, we got to throw these numbers up on the board. That's a lot of wins. I mean, I'd say that I've been doing this for a long time, right? That's a lot of wins. What that is in real-time alerts. I have a lot of losses too, but the batting average is consistent. This year we're batting above our average, or my average for the 18-year look back. That you can look at. You can download all the positions. I mean, the good, bad, the ugly, it's all there. I mean, I'm obviously not Nostradamus. I'm just a guy, a guy with a great team and great tools that's executing on the process every day. And that's really the difference. We've also launched the HAM, Hedgeye Asset Management, hedgeyeam.com that you can check out if you want a shortcut to all this, which are the ETFs that we've launched, and I can't name the tickers. But again, you can just look, you can't look at anybody else in the eye that's running your money every day, can you? Do you know who does it? Okay. What's their name? Can you watch them every day? Can you listen to them annoy you every day like me? Can you engage with them on Twitter? The future is here. Like, we've already built it. So again, you're either part of our community or you're not. If you're about to join it, you're going to live in a transparent, accountable world where there's no bullshit. We don't have to be part of the establishment. I don't need to be buddies with people at the Federal Reserve. Are you kidding me? Or of the political elites. It's apolitical, which is a big deal too. Again, it's all data-driven math. They're just tickers. We're making good asset allocation decisions with our hard-earned capital. Last thing I'll say on performance, top 6, okay? Now, I currently have just inside of 30, like a diversified portfolio, according to me, has a max currently of 30 positions. There are the top 6 performing positions this year. I'm not a big fan of year-to-date because actually cycle-to-date is what matters more. And if you bought UFO in February and wore it all the way down to the lows of April, you got smoked. We bought it in May. So the number 05 there means the date was the month of May. Silver, same thing. You could have got smoked in silver before we bought it, where the signal got us in. And again, it's not Keith McCullough guessing. It's using the humility that we need to start with every day and saying there are these things called the fractal gods, the math that's embedded in both the cycle and in the machine that gives me a signal to obey, all right? And that's what we did, right? We bought gold, AAAUs, physical gold, gold miners fully loaded, all that. Yeah, and yeah, it's okay. It's correcting as of late. That's what things that go up a lot do. They correct, they consolidate, they spit the people out that were chasing them at the highs that we were selling into. Again, you can see me resizing my positions in my portfolio every single day. Nobody is numb enough or dumb enough to try that other than me, and maybe that's why I've had some success with it. Right? And when I don't, you'll see that too. Q's obviously the easiest thing to call. But again, quantum, the ETF's not in your grandfather's retirement account. Okay? It's in, if you're about to be a grandfather, it might be in your account. So again, I'm assuming, again, I shouldn't assume, but if your grandfather has since passed, again, these are not old wall portfolios. They're modern day portfolios. Those are currently our top 6. What we like to do is ride winners. It took me a good decade to learn that lesson. And what you get with me is all my baggage, right? You get every time I've screwed up, every possible mistake I've ever made, and hopefully I've learned from them and I've gotten better, right? A lot of people that you watch or consume calls from, or even the old wall, you really don't, like, there's no accountability. There's no learning. That's why Hedgeye's winning. It's great. Let's get into the process. Is that good, Emma? Is that enough about that? I said I'd spend 10 minutes talking about performance.
Yeah.
Wow. Yeah, it's what it is. Let's get into guys, if you go to slide right off the top, how we explain, well, why do you do it this way? Like, why do you have the humility instead of cockiness? It's confident Keith, right? It's not cocky Keith. It's Keith with a K, right? We live in a K-shaped economy, a lot of different ways to think about this. But again, what we're trying to do is tell you that we start with the humility of saying very important words that people on Wall Street typically won't tell you, and also words, if you're honest with yourself, that you don't ask for. I don't know. Right? Just say it. Right? It's a disease of the mind, right? You need to know. You need Goldman's conviction. You need drawdown Josh Brown to tell you whatever you need to, God help you if that's what you need. And I mean it. Again, what you need to do is have a process that has the humility to wait and watch, to get you out of things on time. We got out of crypto and Bitcoin once again. We've done that quite a bit and quite accurately before drawdowns and crashes. Again, who gets you out? We got our European equities, a whole bunch of things. So again, this process is built on the fundamental premise that the machine is quite the thing to front run. Okay, so let's go back one, guys. Can you go back one slide to slide 4 just to make that point? When I started in the business back in here, actually started in 1999. But again, I was super cool, man. I was like a hedge fund guy. Awesome. Let's see how these blue bars back then were better than these. ETFs? Who the hell wants to work for an ETF? Eh? The ETFs suck, all right? I mean, there was no ETF. Now, look what's going on. These are the ETFs and these are the hedge funds. Why are the hedge funds losing share every single year in AUM terms? Performance, right? Fees, right? Bogle did a great job introducing lower fees. I have lower fees and I have better performance. So again, because I learned that Captain Stockpicker died at some point in 2008 and that front-running the machine's flows. Now, this is really important. If you could be from the future and front run it, you would be, right? Now, a lot of people in the establishment, they get around that by doing what? They get inside information. Pelosi wouldn't be a meme if that didn't happen, right? How many people at the Fed had to step down due to their insider trading or trading in front of news? Yeah, that's one way to do it. That's called cheating. But again, at Hedgeye, we do not cheat, lie, steal, or put up with anybody who does. Right? We're very consistent in that. What we want to do is proactively, again, tell you that if we could tell you, guys, go to the next slide, that the rates of change of growth or inflation were going to do X or Y, then we know what portfolios we're probably going to own in that environment. Okay? So we don't sit here and lament about like the feel of the market or the valuation. This is totally old wall. Right? This time's different. It can or cannot do that. Economic theory, which I'm well studied in. We start with math, fractal math, the behavioral psychology, again, the positioning of the market. S&P 500's had a net short position in it for a long time. People have gotten completely blindsided by this rally as they did the crash before the rally started. So again, it's been a great year on that front. And then, of course, history. What lessons are there in cycles, knowing that every cycle is different, but there are some fractal patterns within the cycle that repeat. Two of the biggest ones, again, this is called the sine curve. Two of the biggest ones are that when the rates of change of growth and inflation start to slow at the same time, that's quad 4. And when the rates of change of growth and inflation are accelerating at the same time, that's quad 2. The worst of times, the best of times. Along the way, there's these things sometimes called quad 3 where growth is slowing. Then eventually you get to quad 1, reaccelerating. Again, the quads will be what the quads are. Goldilocks, to Emma's point at the beginning, we've essentially gone from a quad 3 stagflation in September, heading into, we had a Goldilocks, what we call Goldilocks quad 1 in the month of October, which is previewing a quad 1, full-blown quad 1 to start 2026 for the entirety of the quarter and into the next quarter, okay? We'll review that, okay? That's called the quad 3, 2, 1 count. Now, we've made some pretty sophisticated investors into, out of a lot of people that wouldn't have known that otherwise, but anyone can count down from 3 to 2 to 1, right? Even I can, right? A lot of people have said for a long time, well, he's not that good. He's just, because I had like the lowest SAT score at Yale. On paper, I would definitely not be the guy you'd call the smartest guy in the room. No. I'm just the humblest and the hardest working and the most disciplined and consistent. I take those characteristics over being the smartest just because I can't be. But again, like, if you don't know where these quads are, you got them from us, okay? Goldilocks is the top left corner. That's where small caps, meme stocks, anything, you pick it, rip it. That can absolutely work, especially when you go from this 3 to 2 to 1. So again, you think of it quad 3. First of all, you had quad 4 at the lows, February and April. Then February through April. Then you hit the quad 3, back and forth quad 2. Now we're signaling, the market's signaling quad 1. Go to the next slide, guys. All right, so on this, what we call our spaghetti chart, okay, the chart that they tried to start me with, this can get you a little, you might see this from people who've tried to steal it from us. It looks quite similar, doesn't it? That's what happens, right? People steal great ideas that are innovated by great companies like ours, and we're very proud of this, and we're protecting it. But again, this is where you're at. A lot of people think you're over here, but the puck's over here. Yeah, Emma didn't become the captain of the Yale women's hockey team by not understanding that where the puck is going is much more important than where it's been. Right?
Oh, yeah.
You big on that one?
Oh, yeah. I love that.
Look at that. Just put a puck right here. You know, buy Q. If you could be from the future, that's what the market currently is saying, that there's going to be a decisive quad 1 in Q1 of 2026. Now, how could somebody who's with all of his humility come up with that point? Decisive. That's a pretty important word. That's a high probability word. That's not a 100% chance word, but that is telling you that I have conviction in that, not only because the market is signaling that, but because last year was such a shit show that that's what you're comparing against, okay? So that's how the model works. It models against these things called base effects. So if you don't know what the base effect is, think of it like your former self, right? I'm 50 now. 25-year-old Keith, very different. Base effect, right? So now if I tried to like outrun, outlift, outgrow hair, out anything, pretty much physically, my 25-year-old self, what do you think? Do you think the probability is rising or falling of that? Falling, because I have tough base effects, right? So when the economy slows, those become easy base effects. So think of it like going up and down a hill. When the base effects ease, you're going down the hill, therefore you can run faster or you can walk faster. If you're going up the hill because the base effects are getting tougher, the probability rises that you slow, or at least I do. You ever try like walking up like 8,000 feet at 50 years old? Now some people are like, I'm awesome at that. I was never an athlete, but at 50 I'm feeling fine. That's great for you. That's not the point I'm making. It's hard with analogies sometimes, but hopefully you get the point. All right, next slide. On the process, so again, we're going from 3 to 2 to 1 on those quads. This I'm going to bleed your eyes out for like, this is not a magic trick. I'm only going to do it for 30 seconds. All of this, these are the quarterly returns by asset class, factor, exposure, anything that ticks in macro. And that is the past, right? That's not the starting point, like in terms of like, this has to be my portfolio tomorrow, but this is what's happened historically by quad. This is expected value by quadrant, quad 1, 2, 3, 4. Next slide. I said 30 seconds. I lied, it was less, right? People don't want to look at numbers, they want to hear narratives, right? Like, give me a narrative, give me a narrative. I don't need a narrative, I need to get the numbers and then I'll tell you what the narrative is after that, okay? So again, when you go from quad 3 stagflation, what is the best thing you can own go back to that last slide? If you could read that like AI could, and that's a thing, right? You see how some of you like love AI, love it, but you can't somehow grasp that that slide is entirely incorporated by AI, the machine, in the market at this point? Huh? Right? What the hell is wrong with you? Right? The machine is way smarter than a human being. Right? So in quad 3, these are ranked by, go to the one with the words. People can read words better. Sometimes cartoons even better. We're good at those too. Yeah. This means that this is the number 1, because it's ranked ahead of these two things, is the number 1 asset class you could have owned into quad 3. Now, what made epic all-time highs most recently in September and into the early part of October in quad 3? Our asset allocation to gold. That's why we've made so many friends in the gold community. We don't want to be friends. We want to be, well, we could be friends, but we don't want to be permanently bullish on gold. We want to have front run going into quad 3 stagflation. Now, the problem for gold is that you're coming out of that. And by the time you front run this, do you see gold in any of the top performers here? Gold's up 60% this year. What more do you want? And it's not about what you want, and it's not about what you need. Even though you make it that way. You make it hard on me. I struggle. The market doesn't give a shit about what you want or need. The market's going to do what it's doing when it's front running the next economic environment, okay? You got this. I know you got this. So look at this. Small cap equities, mid cap equities. See that? Mid cap equities. You know, different sectors that we went from long to short and then back again. We're going to stay with our consumer staples short because it sucks. You know, the being long that sector sucks. And the market's already front running that. It goes down on market up days, it goes down on market down days. Okay? So again, we're not using this as we have to own these things. We're understanding that history has rewarded some of these things and punished some of these other things. And we take the signal to say, does that confirm or deny what you should be doing here? So again, it's signal to quad. Guys, let's do the signal. and then we'll get into what people really want. Some people just want the conclusion. But I often say, like, okay, if you just want me to go, you want to go up to Lake Nipigon. I'm from Thunder Bay, Ontario, if you haven't heard. So it's like where investors are born. Yeah, Wall Street. Yeah, that's why I'm here. You know, like, God needed a Canadian, evidently, to take down the old wall. I mean, look, but if we were to go fishing, like, would you prefer me to teach you how to fish or just to give you fish? Now, a lot of people just want fish. Go to themotleytool.com, CNBC or whatever, comedy channel. You know, you can get picks. It's a joke, right? Like fish, like rubber ones. You know, we're going to teach you how to fish. Okay, so again, it's signal to quad. Okay, so I built this signaling process. It's fractal in nature, being fractal. What's fractal? So fractal assumes all information and does not look for talking points that are easy for humans to understand. And what I do is I built the signal on a multi-factor and multi-duration basis. Okay, multi-factor. You can't see the calculation, but the factors are the rates of change of price, the rates of change of volume, and the rates of change of volatility, all in one, where your AI signal will, calculate this thing called a fractal dimension. If you want to try to build one yourself, pop that in GPT, said Mucker said it's a fractal dimension, what the hell do I do with that? You're going to have to know some math. To know what a 50-day moving monkey is requires I've tested all 4 kids on this, a 4th grade education. Wall Street is built on an assumption that a 50-day moving average and a 200-day moving monkey average is the future? Double shaggy. I mean, it's so dumb you can't make it up. Right? Now, I can understand in the prior state, and people get upset because they're like, I'm a technician. Well, yes, somebody else is an astrologist, and they're about as useful to me as you are. Again, interesting information in charts, but not useful. I built it better. And by the way, when I came to Wall Street, I used moving monkeys. And I saw how those didn't work eventually, once the game changed. All right? So again, it's multi-factor, price, volume, volatility, but it's also multi-duration. So we have trades, trends, and tails. Okay, 3 weeks or less. This is super important because it captures what the machine cares most about these days, which is called 1 month price momentum. So, in all my SAT genius, I went with 3 weeks instead of 4. Damn it. Hot damn. What a hot take, huh? You get to front run the number one thing in the machine, which is 1 month price momentum, by being a week early or more. Now, these numbers change. It's not going to be just a week. It changes with the rates of change of volatility and volume. We're not going to get into all the details, and I wouldn't give them away anyway. I've had a very bad experience with people stealing my process before. Okay, again, I don't want to get into litigious events anymore. And then you got the bearish trades, trends, and tails. So what you find with these is that bearish trends trend, and then they crash and collapse. And the same thing with bull markets, like the ones we've seen in Qs. And then they correct, like they might be, today or whatever. This is super short term, and then they go back up to new all-time highs. So your goal is to identify what is bullish trade, bullish trend, bullish tail, and holding all 3 levels of those should be if they weren't your best positions, then you have crappy positions, right? The best positions are the ones that don't go down, okay? So why aren't we buying every damn dip in the thing that should go up? Because it's about to make new highs. That's exactly what I showed you in my top 6 positions. Now, again, we're not going into the right quad for gold per se, like quad 3 was, but you could easily be, the next one should be and has been something like a U.S. equity position that we've just recently added healthcare, for example, after being short it earlier and throughout the year. And I just signaled that in real-time alerts. If you want to see where they're at that day, if it's near the low end of the range, I'm probably going to hit the button in real-time alerts. That's where that like 6,000 or whatever different wins. And guys, you got to throw the losses up there. That's where that comes from, me just sending you real-time alerts throughout the day. So again, trade, trend, tail. If my immediate term trade line breaks, what happens? Do I sell the entire position? No. Sometimes, infrequently. If it breaks trade and trend, do I sell the whole thing? Yes, it's called a stop loss. Again, remember rule number 1 of Fight Club and Hedgeye risk management, do not lose money. Best way to avoid a drawdown and crash is to sell it before it draws down and crashes. Yeah, I like that. you know many people like that, but they can't do that. Because it requires those two nasty words. And I had more than a couple of the C's and D's, right? To have I had a C+ average my first year at Yale. You know how hard that is?
Mine was probably around the same.
I was going to say how hard it was to get to the C+.
Yeah.
So I've had C's and D's.
Yeah.
But the real C's and D's that I have are consistency and discipline. Right? So I stayed with it and stayed with it and stayed with it. I actually won this bloody award at Yale, which is kind of like the most embarrassing award to get, which is your grades improved the most from worst to first in over 4 years. But you have to start at a very low point to win the award, right? So I'm good at that, right? I'm really good at you thinking that I'm not as good as I can be, and in my own mind, for whatever reason, understanding how good I'm going to be, right? Because I use all these weaknesses and mistakes, right? So this is where I'm at, like, philosophically, I guess, if you're looking for philosophy on the whole thing. But again, cutting losers quick and letting winners run, that's about as critical a lesson as I can give you. All right, I think we've done enough on the quad setup, quad 3, 2, 1. What slide is this, number 9? I think we're good on that. I think the next thing to do is to, okay, let's just say you understand that. I understand that it's a bullish trend or a bearish trend. I understand that the quad confirms that that's what it should be. Okay, I got my signal and I got my quad. Now, the best players in the game know those two things and get number 3 right. The portfolio position sizing. The number one thing you can get wrong and even get the other 2 things right is sizing. Okay? This is not watch some TikTok video, right? You're watching an aging, beaten, winning, whatever, chubby Irish guy tell you about all of his wins and losses historically to get to the very basic portfolio construction that you need not to screw up. Okay? So, okay, let's start with, if your portfolio has 4 positions, that's not a portfolio. Okay? If your portfolio has 20 to 30% sizing with YOLO options on them, that's not what we do. If you want and need components of what we do to do that, you do that. But I'm not accountable to that type of behavior. Again, for a certain part of the account, you can do it. But if you're looking at your retirement account and you're looking at a properly sized portfolio, you need to determine what is your minimum position by size and max before you even get in the game. All right? Anything else in your life, do you decide that? Like, where's the brake? Where's the ignition? Like, there's nothing else actually in your life that you do that way other than gambling. Okay, I'm just going to put it all down on black because I'm hammered and I got nothing else to do here, right? You're right, and you're done. 100% of people who play the game on a levered basis consistently and go pot committed, all in, eventually are out of the game. We want to keep you in the game. Best way to stay in the game, stay diversified, and have the right position sizing. So again, why is we're currently long the US dollar, which I'll get into. ETF is UUP. Gold, we consider that a currency. Again, max position is 12%. My minimum position for these, which I'll just do for today, 3%. Why would you have a currency position if it's like less than 3%? You could be right on the damn thing. It can go up 10%, and a currency would be an all-world success, and you'd only make 30 basis points on a 3% position, right? But they're super low beta. So because they're lower beta, in other words, they go up and down less, you can get bigger in lower beta positions. That includes, number 1, foreign currency. Number 2, fixed income. So my max position in something like TLT would be 10%. LQD, investment grade credit, et cetera, et cetera. Equities. Qs, I won't go beyond 6%, but I'll add quantum, and I'll add UFO, and at my max, I'll have 18% right there in 3. What's 6 times 3? Yale genius. Yeah, and then commodities. They're commodities, right? So if it's like something like we've been long, like uranium or palladium, PALL. See, I even have crappy writing. My wife tells me that all the time. Those are high beta positions. If you want to get mad at me throughout the day, take a 30% position in uranium. Actually, the last 3 days, you would have lost your year. It's not about me, it's about you, right? Whenever I get frustrated with you, it's about me, because I don't know what level you're at, and I got to empathize with what you need to figure out. I got to empathize with a lot of you. I mean, God knows who you've been listening to your whole time, right? Yeah, this is the real deal. You know, you got to get this right. You want to take some options positions? Are you going to take your whole net worth and slap it into some NVIDIA weekly calls? size the bloody things accurately in terms of, okay, options for me is the amount I'm willing to lose, not the amount I'm willing to bet. Big difference. Okay, stylistic differences aside, my question to you is, what is your portfolio sizing? Okay, maxes and mins. Again, TLT, my minimum actually would be 3% there. Minimum for these equity positions would be 2%. Minimum for a commodity would be 1%. Can't even see it. It's so embedded in there. It's fractal. Yeah, so have your mins, have your maxes. If you're running a long short book, always have your longs greater than your shorts. Max long 6, max short 3. Right? Don't be an idiot. I've done it. I've been a certified idiot in every possible way, every timestamp way. I have more losses on the short side than anybody in recorded Wall Street history. It's a low bar because nobody else shorts things and puts up their numbers. It's great, right? If you're accountable, think about the realm you could be in, right? You could be just terrible and just celebrate how bad you are at this just because you have no competition in defining what terrible actually means. But again, learn from my mistakes as a short seller. We currently have 11 shorts, I think. We're close to it. 11. I shouldn't say close to it. It's in my notebook. It's 11. We have 11 shorts. And when I think about that, my longest standing short in my short book, is it SPY or is it sugar? Sugar or SPY? Cane. Now, some hedge funds have said, well, I can't, that's too small for me. Well, lucky you, you're so big. You're smarter than me and you're bigger than me, but I'm going to make more money than you because that's how I do it. Okay? So again, longest standing positions on the 3 macro shorts that we have are the Misty. You know Michael Saylor? I'm short him. We were short Sam Bankman-Fried. I'm not saying Saylor is that level, like, in terms of diciness. Bankman-Fried was a fraud. Saylor's just full of shit. Okay, so MSTY, and my third one is my top U.S. You want to be short U.S. equities? Why don't you short the sector that's gone down the most before it goes down the most? Those are our top 3 shorts in terms of time held. I don't short and hold. I short and risk manage. Big difference. I don't buy and hold. I buy and risk manage. So instead of people guessing or saying, oh yeah, right, you did that, or you didn't do that, you're an asshole. Don't call those. Come on. Kids are listening. I just started showing everything I do every single day. Yeah, for a price, and we've launched a big asset management business on the back of it. But you can, if you want to pay the number, which isn't like, I wouldn't say it's like crazy number, for Macro Pro, you can see what I buy and what I sell inside of my positions every single day. Right? There's no debating this. You either do or you do not have skin in the game. You either do or you do not show every single position change that you make throughout the day. I do. Haven't been doing that part of it for the last 18 years. I've been doing it, but I've been showing it. Now I'm just too damn old to care. And by the way, this is a young man's game, a young woman's game. Right? This isn't a game where, like, for some dude who's 95 years old to wake up every day at 4:30 like I do. This isn't a game for some person to wake up and just dial into their doom scroll, whatever they're doing in their basement, and be a team of 1 + 0 edge or hedge.com. No. It's a team game. We have a big team. Thank God for them. Thank God for our machines, our algos, etc. Because I couldn't do this alone. I'd look as bad as my SAT score. Okay, so there you have it on all that position sizing review. So we have some time here now to get into. Let's do one position by each asset class. Can we scrub that down so I can start over? I made a mess of that. Thank you. AI? No, just an eraser. All right, let's get into this. So, TLT. We're going to do this one first. TLT. Actually, let's just see what we're going to do here. Just to make sure I stay on time. We're going to go long TLT. You should have been buying that the last couple of days, by the way. So then, instead of waking up in a panic attack, you're making money on the long side of your TLT. See how the TLT's up today? Yeah, it's portfolio. You want to have different positions working on different days. So I hadn't bought that one in a while, but most recently added it.
here we're going to go with healthcare, as I mentioned, XLV. On global equities, we're going to go with Aqua, which is global water. Who doesn't want to be long of water? Emma, do you like water?
I love water.
How much water do you drink in a day?
Quite a bit, yeah.
Have you measured and mapped it?
Not exactly, but definitely probably more than the average person.
We've invested in water. What's that machine that we have? That thing's
Oh, the
awesome.
bevy? Yeah.
We have the bevy machine. So we don't just have water. Like, we treat our teammates very, very nicely here. Tremendous. Like nothing you've ever seen. What's in these things? You can have electrolytes.
Like different flavors, electrolytes, vitamins.
Sounds like a multi-factor water. See, we're not just long water, we're long global water. Okay, so we got Aqua in there. That's going to be the global equity piece. The currency piece is going to be the UUP. I mean, we're going to come out with a product, by the way, that starts with all this, like just as a baseline. Because what I've realized is like there are a lot of like really low-level players, and then there are some people who think they're high-level players who are getting their ass kicked that are just old wall players. So what we need to do is have a reset. We need to start people right out of college with like one position in each asset class. Now we're going to charge a far lower price for that, and the portfolio is going to do far less good because diversification is the answer to your dreams if you really have them, to generate alpha over time. But anyway, so we got the copper, international equities, put it over here. We're going to have Australia. That's actually the weakest of the signal strengths that I'm going to pop on the board. And then on the short side, we're going to stay with the Philippines. Who told you to short the Philippines? I didn't even put it in my top 3 because it's not my top. It's actually number 6 in terms of time held on the short side. The Philippines. Philippines. Yeah. It's quad compliant, signal compliant, not in that order, reverse it. It's signal to quad. We've been short the Philippines. It's been phenomenal. It even has some alliteration in that. Right? Okay. So what do we got? 1, 2, 3, 4, 5, 6, 7. They told me to go through, yeah. Is that 7? Yeah.
Yeah.
I can count. Big time. All right. So on the TLT, let's go back to the spaghetti chart or the quad map. What the quad is telling you, again, where you do not want to be long of the treasuries. And actually, the least gold you want to own is in quad 2. But the thing you really don't want to own in quad 2 is the treasuries. Okay? Now, to a degree, quad 3 can be a bit of a problem, especially if this sucker inflation, which has been accelerating many, many times now. We have the most accurate inflation nowcast on Wall Street, have for a while now. You can ask anybody who runs like the biggest books on Wall Street. It's just an empirical fact. I mean, when you print the numbers every week like we do in every month and they're that accurate, it is what it is. But you do not want to be long TLT over here. You want to be long TLT max size when this happens. And we don't have that, but it is a nice position to have in case that happens. And by the way, for the month of December, we have a quad 4 coming on a monthly basis. There's a little off-ramp there. Oh my God, he just talked for like 40 minutes and now he's saying quad 4. No, I didn't, but I did. Okay? I said quad 3, 2, 1 on a quarterly basis into next year, but there's this 1 month that could have a very narrow quad 4 that currently the market isn't exactly concerned about, but if it is concerned about it, you're going to get paid in TLT terms. Right? TLT does well over here as well because inflation's decelerating. If you look at the ISM report, for example, yesterday, we review these things on the macro show every morning. You had new orders go up and you had prices paid go down. That's called quad 1. Okay? So that is very bullish for the TLT. Now, the way to think about the TLT too is you don't just go buy it. You have this thing daily called the risk range. Okay? So every day I publish the risk range for the 2-year yield, the 10-year yield, the 30-year yield. Now you can use I know TLT is 20 years because I know a lot. But really you can use the 10-year and the 30-year as a good proxy because it puts it in between. And if you look at this morning's risk range on the 10-year, for example, it was 3.92 to 4.12. So that's the 10-year yield risk range, okay? Now bonds, for those of you that are new to this, and there are plenty of people who don't know how to trade bonds or risk manage bonds or certainly invest across the entire investing cycle on bonds into the proper quads. But I digress. The top end of the risk range for the bond yield is usually the low end of the range for the bond. Okay? So you buy the TLT when it's up around, when the yield's up around there, and you sell some TLT when the bond yields are falling towards there, because that's when the TLT go back up. Okay? Comprende, muchacho? Simple?
Simple.
Right? Now, if we were about to go into quad 2, the probability of going into quad 1 in Q1 is highest. If that weren't to happen and our inflation nowcast were to change, in other words, oil would start to go up like 20 or 30% instead of still crashing, which is the number one factor in our inflation nowcast, which continues to tick lower every single day. But oil goes down in particular. Or sugar, or I mean, there are plenty of things that are going down. You saw it this morning. I was showing you like all sorts of stuff just collapsing. Lumber prices are down 12%. I mean, did you know that orange juice? You ever watch Trading Places? That's probably a little old for you.
No, I haven't seen that.
Just epic movie. Eddie Murphy, Dan Aykroyd.
Okay.
Orange juice trading.
Orange juice,
Yeah,
okay.
it's a lot. You know, minus 20. It's down 22%. Yeah, look at that. See that? See how we have all this data? So when you get up in the morning, like, and somebody tells you things are getting more expensive at the grocery store, we're like, what the hell does that mean? I can tell you based on the futures prices what they're going to be listed at the grocery store because I'm from the future. And they have to buy it at cost. So again, these things are happening, right? We're getting inflation starting to break down finally, which is very bullish for bonds. Okay, so that's the TLT. Let's go back to that. Can we go back to that page where I had the positions? The dollar. Now the U.S. dollar position. Actually, let's go right to. So this one again, we have in foreign currency we have this, and then let's jump over here, and we have this. Short FXE, FXY, FXC. Am I clear here that I'm long the dollar and short even my homeland's currency? I am Canadian. Right there. Look at all those charts. Would you have been short them and long the dollar, or would you prefer to read some bear porn newsletter that's talking about the debasement trade that's going to be short the dollar for life? If these newsletter guys had a timestamp P&L, they wouldn't have to get all your subscription revenues. Right? It's terrible, right? It's just terrible. One-way bullshit, milkshake theories, and the whole thing. But this is our position. Okay, that's what matters. Now, what most people who don't understand currencies don't understand is that currencies are, generally speaking, relative trades to the other countries with currencies. Okay, so let's go to slide 31. We'll hit on that. And again, these are the quads by country. Okay, and I'm only going to go to the G20. We currently model upwards of 50 different countries. But let's just use a very basic example of the quad count. So in the USA, we have this, it's actually 321 that ends in a 1 over here. So this 1, this is to that Q1 of 2026. See that? 1. Why would I be long the European currency that's going 334? All right, USA has 321. Europe has 334. That equals short FXE, the euro. That equals long USD against the euro. What is the number one component of the US dollar index basket? Euro. All right? How about yen? How about UK? Look at the UK. See this? UK is going 233. The UK is going to slow while the US accelerates. What do you think the bureaucrats at the Bank of England in the UK are going to do? They're going to go dovish. They're going to try to devalue their currency. And the dollar's going to go up against the pound. It's already making that move. Again, there's so many, and I'm not even short the pound. I didn't even give you that one, but it's in our daily risk range product, the signal on all these currencies, including the pound. Okay? So that's called differentials in growth in particular, but differentials in quad count is what I wrote about and taught people or tried to coach up in the early look note this morning. All right, let's do the equity pieces, okay? Now, this healthcare thing is really good because when I go double dipping, like you should ask my kids about this. They're like, Dad, you always take the ice cream out of the fridge with just a spoon. Like you don't use a bowl. And I'm like, no, don't. But then eventually they get old enough to know that I do. And I double dip. Yeah. You double dip in your own ice cream? That's when it's getting really tasty. So when I buy 2 healthcare ETFs, that means that I'm double dipping. If I only have one, so for example, Australia, which we'll get into,
Australia is a weaker signal because it most recently broke immediate term trade support, but it's still a bullish trend, so I'll stay with it until I don't. Could be gone tomorrow. You never know. You never know. You could watch this webcast and I could sell everything that I'm long and short it. Probably doesn't happen tomorrow, but Australia is the closest thing to it. If I go long, like we've been long India 2 different ways, small cap India and mainline India. We've been short India 2 different ways this year, which is the same, flipping to the short side of those. Another great asset allocation decision made by Hedgeye. We owned the biggest ramp in Indian stock market history and then shorted it at the turn and crushed it on the short side. That's how you do the job, right? Time stamping every position around the world. Now, XLV, again, here's a good example of, let's go back to the quad slide that has the words on it. All right, so this sector is not here, it's down here. See that? It's also here. Bad sector. But the signal says it already had a bad time in the prior sectors. Healthcare crashed in this one this year and then mightily struggled here, even though it was supposed to do well here. Here's a good example of something that I don't care. I use my analyst bottom up again. So again, we're using also the pods for companies. So again, and in Mike Taylor's pink ETF, which is the other one that I'm long alongside, I just signaled buying it in real-time alerts because it's near the low end of the range today. One of the best healthcare stock pickers in the game. So what I'm trying to do is pick stocks in pick a manager in his case of a sector style that just went from bearish trend to bullish trend, irrespective of what the quads say. Now, just because this says that it's the worst, guys, go back to that bleed your eyes out slide. Like in quad 1, the definition of worst before you lose it, oh, he said. Dude, anytime you're getting frustrated, it's because you haven't taken the time to learn and understand. And or I haven't taken the time like I'm trying to take today to coach you through it. Okay, so listen. When we go into quad 1, can you see these are all the sectors that you could be long, which includes healthcare right here. See this? Healthcare. Is 4.5% quarterly average gain a bad thing? Phenomenal. It's just less than cyclicals and something growthier. Tech is 9.4. But you notice a certified monkey could be along anything in quad 1. See that? So I'm going to go with what the signal thinks, because the quad thinks that they're all going up. When it says worse, because we're human beings, you hear the word worse. That must be bad. No, it's just less good is what it means historically. And in this case, because healthcare came from the worst, like healthcare blew, I don't think I can exaggerate how bad of a year Captain Stock Picker in the hedge fund space has had in healthcare. Some of the biggest healthcare long-short managers that you've ever had in the business completely blew up. And now we're just buying their mess, because now they go from bearish trend to bullish trend. We were short healthcare at the beginning of the year. All right, so there's that. I already made my case on water. I think that bull case, I think I'm going to turn that into a newsletter. I always wanted to do that. That the whole like, why would one be long of water?
Yeah.
So we used ChatGPT, and it came up with these phenomenal reasons why one would be long of water. Why does a retiree not own water?
That's a good question.
Do we need to get into this? I don't think we do. You know that anybody can create a narrative for anything, like with ChatGPT, that's actually pretty good? Like, I'm going to do it a little later on. I'm going to do it with the teammates. We've already done it if you look it up, like why you belong of the water. So we got the water in there, the copper. Now, copper is another one similar to healthcare, which crashed and is now in recovery. So we call this a bearish to bullish trend, phase transition. So let's go back to slide 9. Copper is coming out of the hole. So this is what you really want. You want to be short things that are bearish formations, and then you want to go long them. Whoa, geez, come on, back to me. You want to be long them when they do this. When they stop there, and they make a higher low. That should be an H. Higher low versus this. That's point number 1. Then it makes a move through here. Then it makes a move through here. Higher low, bullish trade, bullish trend breakup. That's what copper is. But you don't buy it after it breaks out. You buy it on the correction like it's just had in the last 2 days. Okay? Because now you own something in here that's going here if it breaks out for real. That's why I'm long copper. That's why I am long platinum, palladium, SLX, which is or steel stocks. They all look the same. Copper's the last man standing, the doctor that is waiting to do it. And if we're right from here, we're right for the right reasons. If we start to become wrong, I will stop myself out of the mistake and move on to the next play. That's the whole point about this whole process. I already said my point on Australia. That would be a good example, right? Australia currently just did this. It went to, let's use the right color just to finish on this example. It just did this, right? So you got a bullish thing that just went through here. That's what Australia just did. So it made a lower high here, then it broke trade. Now the question is, will it hold trend? If it breaks trend, I send you a note that says, Keith sold, KM sold, all of his Australia. Again, there's no fundamental reason why you should sell Australia. Go back to slide 31. They have one of the best quad counts in the world. Being long Australia has worked out fine. But if the signal tells me to get out, am I going to stay with these that shouldn't be red, but they got 4 twos in a row. Maybe what the market's saying is that the USA quad is going to be much better than this, and they have to hit a quad 3 after that. Maybe the market's already discounting it. It is November. Right. So again, just wake up every morning like I do if you can, and just think about it. Think about a world where a lot of people are upset. Some people like me are really excited. Not having to care. If people need or want to believe certain things about bubbles or politics, to use the words of the great Mel Robbins, let them. To wake up to a world every day where your money is going to actually be risk managed, where somebody's on the switch with an entire team behind them and all of our machines to make sure that if something breaks, we risk manage our way out of it. Before the break, a small loss becomes a very large loss. And worse, we don't sell something too early because a bunch of narratives by a bunch of doom scrollers and clickbaiters need to get paid advertising dollars to get you to believe that. It's a much better life. You cannot tell me it's not, unless you are in the business of getting paid for doom scrolling and politicking, or both, right? So think about it. Think about everything that we've said in terms of the process. Ask questions. You can obviously ask us. There's Hedgeye University, which we put up a lot of learning content so that you can go through things a little less fast. I have low SAT score, but I talk fast sometimes because it's like singing a song here sometimes. Yeah. We gotta deliver. Yeah. With not a lot of ums.
Exactly.
How'd I do on that, Ethan? Did I have any? It's quad 2. I used to be like that. A lot of issues. Yeah.
All right, so we got a couple quick questions here. So we have a lot of people that are new to Hedgeye. Just curious what you would recommend, where you would recommend people starting in terms of different products for the people that are kind of new to Hedgeye and the macro process.
Now, if I was an old wall salesperson, I would say, buy my book. But instead I'll say, download my book for free, right? I don't need to make more money to be happy. What would make me really happy? To see more people see this better way. And that book is as good as I can do for now, all right? It's a short read for those of you that have a lower attention span. I get it. The average attention span, don't forget, is 8 seconds of a human being currently. So, on reading things. I would definitely, if you want to really get the groundwork, the foundation of it all, where it came from. Mike Taylor writes the foreword. He's the OG, according to me. There's a lot there. So I'd start with that, and then I'd augment that with Hedgeye University content. It's all free, so yeah, go for it.
And then what's the best way to follow your allocations? I know we have some like Macro Pro features that obviously kind of allow people to follow what you're doing, but what are some of the best ways to follow your allocations?
The easiest way to do it is by paying for it in Macro Pro. Macro Pro is our top subscription. I think we have it on a cyber sale right now. It's only this time of the year that we do it. But that's the number one way, right? Because you can see everything I do every day. Like I just sold all of my what we call a treasury curve steepener, right? Talk about going anywhere. I was along this eyeball thing. I have been historically on and off, but sold the whole thing. And I added an equity today that I cannot disclose until it gets disclosed to our subscribers. But since we have subscribers listening, it's not a hot tip or anything, it's just getting out of the position. If you want to get that every single day, you can also get it in ETF Pro, but you're not going to get position sizing, you're not going to get implied signal strength. You know, that's an important part that I didn't talk about in the portfolio. If something's moving down the portfolio, we're either booking a bunch of overbought gains in it, or more importantly, it's losing signal strength. It's very typical that something's falling down the list in terms of position sizing, and then it gets tossed, right? So that's like really important to observe. Again, you get what you pay for, but again, ETF Pro is probably a product that we need to like inflate the price of, because I think that one's too cheap relative to the. If you could have beat most hedge funds that do global macro this year by just subscribing to ETF Pro. That's pretty good. Why don't you start a hedge fund?
All right. Well, great. Thank you, Keith. And as Keith mentioned, we are offering our best deals of the year, so please check out our products, and that'll do it for us today. Thank you for joining us.